Hi, everyone, and welcome to the Buffett and Beyond Research Stock of the Week. And today we're going over Netflix. And folks, it's up 90% in the past 12 months. And remember, if you want to walk on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And folks, let's see what Netflix does, as if we didn't all know already. But Netflix is the world's leading entertainment services business with about 302 million paid memberships in over 190 countries. Didn't know there were that many countries, folks. Providing TV series, boy, which we watch all the time, films and games across a variety of genres and languages. And it discontinued the DVD by mail service. Remember that? Seems a long time ago, but it was only the beginning of last year that they discontinued that. Reportable segments, the U.S. 41% of the memberships, and international 59% of those memberships come in from overseas, and has about 14,000 employees. Now let us look at the numbers. Now the quick chart here, the thumbnail sketch, is Netflix, and these are 5-year averages. So when we look at the blue bars, which are the average stock in our entire database, the clean surplus ROE is about 13.5%, but for Netflix, it is double that, folks, more than double. So yeah, it's performing very, very well relative to the other stocks out there in the stock universe. Net income almost twice as much over here, 13% for the average stock, 24.3% for Netflix, and revenue almost double that of the average stock. The average stock 7.1% and Netflix 12.4%. So the thumbnail sketch says, okay, this is a stock that's beating all the other average stocks out there. And the whole goal of our methodology of clean surplus is to outperform the market averages, which over any 10-year period, 96% of professional money managers who manage those publicly traded mutual funds, 96% cannot outperform the S&P 500. So this is a nice methodology, clean surplus methodology, to compare one stock to another stock. And right now we know we are outperforming the averages with Netflix. And let's go to the individual numbers, and I just want to show you here that here's the clean surplus return on equity. And to get into our growth portfolio, we want to see a ROE, a clean surplus ROE of 20% or better. And Netflix, yeah, has been in the 30s all along for this whole group that we have here, or this group of stock statistics that we have right here. Retention rate, 100%. That means they're taking all the money they're making and putting it back into itself in order to keep those earnings growing. Because when you look at the clean surplus ROE, this means earnings are growing faster than the average stock, almost 2.5 times that of the average stock. Now, the years to pay debt, this is Buffett's rule of thumb, 1.2 years. That means if it takes all the money it's making, how long will it take to pay off its debt? And Buffett's rule of thumb is 5 years or less. Our rule of thumb is 3 years or less. And the years to pay debt for Netflix is 1.2 years. So a rise in interest rates will not hurt this company very much at all. And let's look at the last 12 months. Wow, black line's the S&P 500. It's up about 13.5–14%, while this stock is up about 93–94%. Unbelievable. Now, the new numbers that just came out are not included in the, let's go back here, not included in this ROE, because this is a yearly ROE, and the numbers that just came out are the quarterly numbers, and so we don't know how much it will affect 2025's total return on equity or the projections for 2026. But this is a hot company, folks. And let's go to the past 5 years, and we can see this is 2022 right in here. And for some reason, Netflix went down in value more than the S&P. The S&P is the black line. The S&P was down 19.6%. NASDAQ was down 34%. And since Netflix is part of the NASDAQ, we can see why it fell so much, but not as we would think. More people would be staying home watching television in 2020 and then 2022. So this stock was following the market averages up to 2022, and then in 2022, when we thought there was going to be a recession, that's why the market declined, and Netflix declined further. But right about the middle of 2022, right in here, this stock took off and has not looked back, except this one little blip in here a couple of months ago when all the tariff talk first came out. We didn't know how that was going to affect Netflix. But then again, Netflix is just the push of a button. It's not like they're importing things or exporting things. It's all electronic, folks. And boy, look at this climb over here over the past about 2 months or so in here. So yeah, it's doing very, very well. With the market up about 90-something percent, this stock is up about 155%. But look at this rise over here. If we had bought more at the bottom, but we've owned this stock for such a long time, this is a really, really nice rise in here. So, folks, we had another good week this week, and boy, things are looking good. A lot of growth slated for the US of A in the next several years. A lot of AI talk going out there, AI centers built all over the place. Amazon has built one already, and it is huge. 5 data centers, each the size of a football field, in one spot alone, and they're looking to spread into Pennsylvania, maybe North Carolina. So they're looking, and we'll hear about that real soon. So yeah, Netflix is situated to do very, very well. It's using AI in some of its scripts and things like that. So everything's looking good in that whole segment, and Netflix is the leader in what it does. So, folks, as I said, we had a great week. You go out, enjoy the weekend, spend some of that money you're making on this stock, and enjoy yourself. Most of all, stay safe. And, folks, we'll see you right back here in a couple of days.